A currency trading floor in London, Monday morning, August 16th, 1971. The teletype machines are running before the traders arrive. The overnight news from Washington has come through on wire. Nixon suspended gold convertibility on Sunday evening. The Bretton Woods system, the architecture that has organized global finance since 1944, is, in some legal sense, no longer operating. I've spent time reading the contemporary accounts from that morning, the Financial Times editorials, the internal Bank of England memos, the diary entries of Treasury officials in Bonn and Tokyo. What strikes you, sitting with those documents now, is how total the consensus was. Not just that the dollar faced serious trouble, that it faced an existential crisis, that the removal of gold, the anchor that gave paper money its credibility, would set off a chain of consequences that no government could fully control. The governor of the Bank of England described the situation as the most dangerous since the 1930s. Deutsche Bundesbank officials prepared internal analyses projecting severe dollar depreciation. Economists at top American universities published op-eds forecasting the end of the dollar's reserve currency status within a decade. They were not fringe voices. They were the best credentialed monetary experts of their generation, and they were wrong. This is a story about why. To understand why the collapse seemed so certain, you have to understand what gold actually meant to the post-war system. July 1944, Bretton Woods, New Hampshire, 44 nations assembling in the final year of the Second World War to design the monetary architecture of the peace. The British delegation, led by John Maynard Keynes, they arrived with a proposal for a new international currency, the Bancor, that would allow global trade to function without any single nation bearing the burden of reserve currency status. The Americans, led by Harry Dexter White, rejected it. The U.S. held more than half the world's official gold reserves. The dollar, backed by that gold, would be the anchor. What emerged was a system of profound logical elegance. Every currency pegged to the dollar pegged to gold at $35 per ounce. Any foreign government could walk up to the U.S. Treasury window at any time and exchange paper dollars for metal. The gold backing was not just a financial mechanism, it was the philosophical foundation of the entire arrangement. It answered the oldest question in monetary theory: why should anyone accept a piece of paper as payment? Because behind that paper stood something that could not be printed, something finite, something that had stored human wealth for 3,000 years. So remove that foundation and the question came roaring back. Why should anyone accept the paper? In August 1971, that question had no obvious answer. The experts who predicted disaster were not being unreasonable. They were following the logic to its conclusion. The predictions made in the days after August 15, 1971 read, 50 years later, like a remarkable document of collective expert failure. Henry Hazlitt, one of the most respected monetary economists of his generation, wrote that fiat money had never survived in the long run and that there was no reason to believe the dollar would be the first exception. The gold-to-dollar ratio implied by actual gold trading suggested the dollar was overvalued by a factor of 3 to 5 relative to what market equilibrium would dictate. A survey of economists conducted in the autumn of 1971 found that the majority believed the dollar would lose its reserve currency status within 15 years. The Bretton Woods architects themselves, though still alive, were almost unanimously pessimistic. Robert Triffin, whose 1959 testimony had predicted the Bretton Woods collapse with precise accuracy, published a new paper arguing that fiat currency was not a solution. It was simply a different kind of trap. Verified these numbers against the Federal Reserve archives before writing this section. They confirmed the picture. By 1971, there were 4 times as many dollar claims outstanding globally as there was gold in the U.S. Treasury to honor them. Every foreign government that held dollars was in effect holding an IOU that could not be paid in the terms under which it had been issued. The experts predicting collapse were looking at the same numbers. Their logic was correct. What they missed was not mathematical, it was structural. The conventional explanation for gold's role in the Bretton Woods system was that it provided backing, a physical store of value behind paper currency. This explanation is not wrong, but it misses the deeper function. What gold actually provided was a constraint on behavior. A government that had to maintain gold convertibility could not run unlimited deficits, print unlimited money, or make unlimited promises. The gold window was a discipline mechanism, not because governments were virtuous, but because the window was always open and foreign governments always had the legal right to use it. Remove the gold constraint and governments could, in theory, do anything. Print unlimited money, run unlimited deficits, make promises they could not keep in metal, but could satisfy with more paper. This is what the 1971 pessimists were actually predicting, not that the dollar would fail overnight, that without the discipline of gold, the political incentives would eventually produce exactly the kind of monetary behavior, expansion, inflation, debasement that had destroyed every previous fiat currency experiment in history. They had history on their side: continental dollars, assignats, Weimar marks. The graveyard of unbacked paper money is long and well documented. The question was not whether fiat money could work in theory. It was whether this particular government, at this particular moment in history, with its particular political incentives, would exercise the restraint that gold had previously imposed by force. Looking back through the 1970s, the monetary expansion, the oil shocks, the stagflation, the gold price rising from $35 to $850 in 9 years, the pessimists had a point. For nearly a decade, the dollar behaved almost exactly as they had predicted it would. From 1971 to 1979, the dollar lost approximately 50% of its purchasing power in domestic terms. Inflation then climbed again, reaching 13.3%, then climbed again, reaching 13.3% by December 1979. At that compounding rate, the cost of living would double in roughly 5 years. Gold, freed from its $35 anchor, rose to $195 by the end of 1974. It kept rising. By January 21, 1980, the London afternoon fixing hit $850 per troy ounce. In 9 years, measured in gold, the dollar had lost more than 95% of the value it had carried under Bretton Woods. The dollar was also experiencing its first serious competitor for reserve currency status. German marks and Japanese yen were both strengthening against the dollar throughout the decade. Central banks in several countries began diversifying their reserve holdings away from dollars. By 1978, Treasury Secretary Michael Blumenthal was negotiating what became known as the Carter bonds. U.S. Treasury securities denominated not in dollars but in Deutsche Marks and Swiss francs because foreign investors no longer wanted to hold dollar-denominated debt. The United States was borrowing in foreign currency because confidence in its own currency had eroded enough that lenders were demanding the exchange rate risk be shifted to the borrower. The pessimists of 1971 were not wrong about the decade. They were wrong about what came next. October 6, 1979. Paul Volcker has been Federal Reserve Chairman for 60 days. In a Saturday press conference, unusual enough to signal that something extraordinary is coming, Volcker announces a fundamental shift in Federal Reserve operating procedure. The Fed will no longer target interest rates directly. It will target money supply growth, and it will accept whatever level of interest rates that target requires. The federal funds rate, which had averaged 11.2% through 1979, would rise to 20% by June 1981. The prime rate reached 21.5%. What happened to the economy was brutal. 2 recessions in 3 years, unemployment rising to 10.8% in December 1982, the highest level since the Great Depression. Manufacturing communities across the industrial Midwest entered a contraction from which some never recovered. Volcker later recalled that the protests outside the Federal Reserve Building in Washington were unlike anything the institution had seen since the 1920s. Construction workers mailed him 2x4s, reminding him what the interest rates were doing to their industry. Farmers drove their tractors to the Fed's front door. The way I read Volcker's subsequent testimony and memoirs, he understood exactly what he was doing and to whom. He had been present at Camp David in August 1971 as Treasury Undersecretary, one of the architects of the gold window closure. He understood the discipline that gold had provided. He had spent the intervening 8 years watching the consequences of its removal. What he attempted in 1979 was a substitution, replaced the external discipline of gold with the internal discipline of an institution willing to impose pain. The moment the dollar was saved was not August 15, 1971, when the gold window closed. It was not the Smithsonian Agreement of December 1971. It was not the petrodollar arrangements of 1974. It was not any of the events that the contemporary experts watching the system in real time identified as decisive. It was October 1979, the moment a central banker decided that the political cost of credibility was worth paying. Because what the pessimists of 1971 had correctly identified was the problem, but incorrectly modeled was the solution. They assumed that without gold, there was no mechanism by which monetary discipline could be enforced, no constraint strong enough to override the political incentives toward expansion. Volcker demonstrated that the constraint could be institutional rather than metallic. Not a fixed price of gold, not a legal obligation to convert paper into metal on demand, but a central bank with sufficient independence and sufficient willingness to impose a recession to make credible the promise that it would not inflate without limit. The dollar survived because at the decisive moment, one institution chose institutional credibility over political convenience, and that choice held. The question that the 1979 decision raised, and that took several years to answer, was whether markets would actually believe it. The history of central bank announcements is littered with commitments that weren't kept. Arthur Burns, Volcker's predecessor, he had publicly committed to fighting inflation multiple times through the 1970s, each time when the political pressure mounted, from Nixon, from Congress, from business groups, Burns retreated. By 1979, the bond market had priced in the expectation of continued inflation. The 10-year bond yield was over 10%. The inflation premium embedded in long-term rates suggested that sophisticated investors expected the Fed to blink again. William Silber, Volcker's biographer, described the consensus among leading Wall Street forecasters in 1980 as pessimistic. They had considerable doubt the Fed could accomplish its objective. Henry Kaufman, one of the most influential bond market analysts of the era, opined publicly that the Fed had lost credibility in the real world. What changed this wasn't an announcement, it was the demonstration. Volcker raised rates. The economy went into recession. The political pressure to reverse course was enormous. He did not reverse course. Rates went higher still. A second recession, unemployment above 10%, congressional hearings where Volcker sat for hours of hostile questioning. He still did not reverse course. By 1982, the market had the evidence it needed to update its prior. Inflation peaked at 14.8% in March 1980 and was falling toward 3% by 1983. The dollar had not been saved by gold. It had been saved by the willingness to accept pain in the present to preserve credibility in the future. The forecast failure of 1971 is worth examining carefully because it was not a failure of intelligence or information. The economists who predicted dollar collapse had access to the same data as everyone else. Their models were sophisticated. Their historical references were accurate. Fiat currencies had historically failed at a high rate. The political incentives toward monetary expansion were real. What they missed was the possibility of institutional evolution. The Federal Reserve of 1913, created to prevent banking panics, was not designed to manage inflation. The Federal Reserve of the 1950s and 1960s operated under explicit pressure from the Treasury and the White House to keep interest rates low. Arthur Burns' Fed in the 1970s was the product of an institutional culture that treated unemployment as a more immediate political risk than inflation. None of these historical precedents predicted Volcker. What Volcker represented was not just a different policy choice, it was a different institutional identity, a central bank that genuinely understood its primary function as price stability and was willing to enforce that function regardless of political cost. The dollar survived not because fiat money was proven sound in theory. It survived because one specific institution at one specific moment chose to be the thing that replaced gold. not metal, not law, demonstrated willingness to inflict pain. The 1971 pessimists couldn't model that. They were looking at the system. They should have been looking at the people. The Volcker disinflation did not come without costs, and some of those costs were global. As U.S. interest rates rose to 20%, capital flowed into dollar-denominated assets from around the world. The dollar, which had been falling against other currencies throughout the 1970s, appreciated sharply. Between 1980 and 1985, the dollar rose nearly 50% on a trade-weighted basis. For developing countries that had borrowed heavily in dollars during the petrodollar recycling boom of the mid-1970s, when interest rates were low and dollar credit was plentiful, this was catastrophic. Mexico defaulted on its foreign debt in August 1982. Brazil, Argentina, Chile, Venezuela, Peru, a cascade of sovereign defaults followed. The Latin American debt crisis of the 1980s was, in significant part, a consequence of Volcker's success. Manufacturing in the American Midwest contracted severely. The strong dollar made U.S. exports expensive and imports cheap. Steel mills and auto plants that had survived the 1970s did not survive the early 1980s. Looking back through the employment data from those years, what you see is not just a recession, but a structural reorganization. Industries that contracted during the Volcker shock did not fully recover when the recession ended. The geographic and sectoral distribution of American economic activity shifted in those years in ways that are still shaping the political landscape today. The cost of saving the dollar was paid disproportionately by people who had very little to do with the monetary policy decisions that necessitated the rescue. The world that Volcker's disinflation produced was not what the architects of Bretton Woods had designed. It was a floating exchange rate system, the one George Shultz had argued for at Camp David in August 1971 and been overruled on. It was a dollar standard without gold backing, exactly what the 1971 pessimists had said could not be sustained. It was a system dependent on central bank credibility rather than convertibility, and it worked, at least in the terms by which such systems are measured. Inflation stayed low through the 1980s and 1990s. The dollar remained the dominant reserve currency. Global trade expanded, financial markets deepened, but the 1971 pessimists were not entirely wrong. And they had identified a real vulnerability. Without the gold constraint, the system depended entirely on the willingness of the institution managing the dollar to prioritize long-term stability over short-term political pressure. That willingness existed under Volcker. It held under Greenspan through the 1990s. Whether it would hold indefinitely, that question remained open. The system built after 1971 replaced the mechanical discipline of gold with the discretionary discipline of an institution. The institution is only as reliable as the people running it and the political culture allowing them to do their jobs. That is a different kind of guarantee than metal, more flexible, more powerful when it works, and entirely dependent on something that, unlike gold, can change without warning. The dollar survived August 15, 1971, not because the pessimists were wrong about the problem, they were right about the problem. A fiat currency without the external discipline of gold convertibility is, in principle, a promise backed by nothing but the credibility of the institution making it. It survived because of a specific sequence of events that was not predictable in 1971 and was not inevitable even after it began. It survived because a bond trader from New Jersey negotiated petrodollar recycling arrangements in Jeddah in 1974 that kept global demand for dollars elevated. It survived because an economist from Cape May, New Jersey, raised interest rates to 20% in 1981 and held them there long enough to demonstrate that the promise was real. It survived because the American economy, the depth of its financial markets, the scale of its trade relationships, the reach of its military power provided a foundation that no other currency could replicate. And it survived because the alternative was worse. The Deutsche Mark and the Japanese yen were credible. But Germany and Japan were export-dependent economies that needed the dollar system more than they needed to replace it. The Soviet ruble was not convertible. There was no competitor. The dollar's survival after 1971 was not a vindication of fiat money as a system. It was a particular outcome produced by a particular combination of institutional choices, geopolitical circumstances, and the absence of a credible alternative. The experts who predicted its collapse in 1971 were not being irrational. They were following the logic of monetary history. What they could not know was that this time, the logic would be interrupted by a man who was willing to cause a recession rather than compromise a principle. That is a fragile kind of guarantee. It worked. It is still working. How long it continues to work depends on questions that no monetary theory can fully answer. Only time and the people in the room when the next crisis arrives.